on there.
All right, our participants are filing in. We
Can you
are
hear me okay,
live.
John?
There you go. Yep. Hey, James.
Perfect.
James,
How are you? How you doing, bud?
good, thanks. Good to be with you, James. What a surprise.
Yes, my buddy, this is your call. I want to be here.
Thanks. Well, hey, the attendees are starting to roll in, and I just wanted to say good afternoon to our folks here on the East Coast, and good morning to the rest of the country. We have a pretty special Q&A set up today with our friends from Annexus. Tom Haines, product actuary, investment banker, James Hahn, and Jon Elder. What brings us here today is this quandary of IUL and navigating the very different makeup of the smart beta index. But what I'd like to share with you first is on our screen, just historical IUL. When this launched in, call it 2007, most major carriers had an IUL that was for sale. And at that time, the VIX was 23. The 10-year treasury was 4.76 and caps were 14. So we could, in a Monte Carlo simulation, illustrate with 80% confidence a rate of return of 7.21. Taking the risk off the table, annual reset, this is a really attractive vehicle. But the economic environment changed. And if you fast forward, and what I'm showing you here on the screen is what happened, every August from 2007 through 2021. And as the 10-year treasury declines and the VIX spikes, the natural course of action would be to lower caps. And if you fast forward today, in August, the VIX was 19. Today, it's actually 24. We've been as high as 38. And that occurred in March of 20. So with interest rates at historical lows and further exacerbated by COVID and market volatility, the insurance carriers and the cap strategies have nowhere to go but down. So we're seeing caps in the 7% range. So Monte Carlo simulation, historical 10-year periods, 80% confidence spits out a 4.2% crediting rate. So as we fast forward to today, we introduce volatility control. We introduce smart betas. So there are, in my opinion, no more experienced smart beta than the folks on this call and the team we've assembled for today's webinar. So we're going to open this up. Type your questions in the chat, raise your hand if you'd like, and just have a dialogue with Tom and John and James. And I've put together some pretty tough questions for them to just kind of give us a high level view of what is smart beta, what is smart S&P, and then get into the weeds a bit on how the market looks, why one smart beta is different than the other, what Wall Street looks to do when they create these smart betas, what's the future look like in max funded strategies and premium finance. So we can have some fun. Again, utilize the chat. We promise to get to almost every question that we can. We're going to wrap this at about 12:45 and keep Eastern time and keep everyone on track. So, without further ado, I'm going to introduce Tom Haines first, and I'm going to lob this question to Tom in two parts. First, describe for us what is a smart S&P index, and then part two, what is a smart beta index?
Thank you so much, Anthony. for having us on and for everyone's time today. And really the concept of having a smart S&P index. First of all, what I would say is, one working with actually S&P, S&P 500, that's their most well-known indice, but the S&P Global franchise is the biggest global provider of indices in the world. So they've been they're a tremendous partner. Their oldest index is the Dow Jones Industrial Average, and the ability to work with them on an index that ultimately can navigate U.S. markets in a more tactical fashion, as opposed to the feeling of sit and take it. Sit and take it if you have a drawdown of 20, 30, 40, 50%. Sit and take it when the renewal rates on your chassis start to drop down, your caps are going down, as you just highlighted. Sit and take it that zero is your hero. And the ability to say, well, how can we have something that provides more consistent returns, navigating the US equity marketplace in a manner that allows for maybe at an index level 4 or 5% returns, but then contained into an IUL chassis, bringing, let's say, 8, 9 returns on a consistent basis, is really what we mean by a smart S&P strategy. The ability to, and we use that term in partnering with S&P. We also use it in Annexus when we talk about just US-based strategies that we think are better, such as what our partnership with Nationwide and my work with Professor Roger Ibbotson at the Yale School. Now, what is a smart beta index? That is a method. It's still the idea that, and that term is sometimes widely and changed, overly used. We tend to use that smart beta index to mean something that has a different exposure than just providing the S&P 500. And we tend to make it probably more broad, that it could include going global, right? That there's not just a need to always be in the S&P 500. You need both. And that's a big problem we have in our industry. Everyone looks back the last 10 years and think, well, I'll just go with an S&P. Well, if you look back 20 years ago or 20 years ago, you actually see better opportunities going global. So when we're talking about an IUL chassis, you need both. The ability to go in global, which is not S&P, it's smart, going smart global. And then the other kind of perspective of it, kind of going back to smart US S&P, is smart beta is maybe there's a different way to weight the stocks. The S&P 500 it's a benchmark. It was created in 1956 as a benchmark by the McGraw family. And it's a fine benchmark, but I don't think it ever had a vision in 1956 to be a financial strategy. And it's susceptible to risks. It's not smart. It's actually pretty dumb. For example, when the market gets high, it gets over concentrated to certain sectors. And the S&P 500, how it works is the larger stocks get bigger. It's called market capitalization. And what happens is when you get this over concentration to bubble markets, in 1980, it was energy. In 1999, it was tech. In 2007, it was starting to become financials and insurance. And sure enough, in 2020, it was tech again. When you start seeing the top 5 names of the S&P 500 actually get up to 20, 23, 25%, that's not just being a smart allocation. That's taking a big bet. And that bet could work, right? You can go down the street, Anthony, down the Atlantic City Expressway and go to Atlantic City. But the fact is that bet always going to work. And then we don't want to be in a betting business. We're in a financial planning business. And that's our strategies don't take that type of susceptibility and type of risk. It's really about more consistency.
That's really well said. So to find this one size fits all asset allocation, uncapped vol control is a big gamble when it pertains to a key person supplemental retirement income or an estate plan's premium finance solution. So, and we'll get into the weeds here on why one index is not an end all be all. I'll lob this one over to James or John. Feel free to jump in here. So it seems like every week there's a new smart index that's being released on an IUL chassis from major insurance companies. And I can run down the list of Fidelity and JP and Bloomberg and Merrill Lynch and Barclays and PIMCO. So James or John, give us a high level view of the market and what you're seeing out there as your competitor, being cognizant of your competitors and what you're doing and a little bit differently than the new indice on the block.
Yeah, let me jump in here. One of the things that, and we'll have Tom probably help us button up, what he's seeing too here in a minute. I want to make a quick comment what Tom said earlier about, the smart S&P, and I'll connect the dots on the question around what we're seeing in the marketplace. But I think it's important that to demonstrate, going back to 2014, we were the first product development, the only product development company to come in the marketplace with a smart beta index when the equities were running, right? We just come out of the most strongest equity run that we've seen in the last 45 years, right? I don't think that we're going to see the same type of run in my lifetime. So even in 2014, through Tom's leadership, he was very focused on a going forward basis and making sure that we had something that was very stable, that was going to respond in a variety of market conditions, and not just hope that we bought the S&P at the right time and we hope that we finished at the right time. He wanted to build something that was multi-asset, not just equities all the time, something that was constantly rebalancing to make sure that it was responsive and be able to provide that consistent, stable return. So that was our entry back in 2014, and that innovation continues today. As part of that, when it comes to an IUL, is when you do that, we're very, very focused on making sure whatever you're showing the customer on the illustration, and we all would agree the illustration is 100% wrong 100% of the time, but you still need to demonstrate some way of range where this thing's going to end. And if you don't have a smarter S&P and you're always responding to a volatility spike on the straight up S&P, what we all know is those cap rates come down, and we also know those par rates will come down. Therefore, the probability of whatever you're showing the customer on a straight up S&P design, it can be very troublesome. It can be very challenging. So our goal is to build that smarter S&P model, but also be able to maintain the credibility of the uncapped par rate, so we have a higher probability of meeting the collateral call conversation, a higher probability of meeting that supplemental income retirement goal down the road. Now, what we're seeing now, because of this volatility control index, there's a significant amount of entries in the space, and what we're finding here is they either cover one part of diversification versus the other. What do I mean by that? You may be 100% domestic, and that's all they may have. Or they may be 100% international, and that's all they have. So we're starting to see a consistent message where other players, not to say they're wrong, not to say they won't work, but there's not a combination of both working together, having a smart S&P like Zebra Edge, or another example would be the S&P Prism on the Securian product, and then have an international complementary index. When you have a ZIG, you've got a ZAG, very much just like your assets that you manage for your client, or potentially the assets you have underneath your portfolio, your own money, you've got diversification. Now, in addition to that, and I'll throw this back to Tom because he's much more credible than me on this comment, and then John jump in here, is you're also seeing that some of these index allocations are out there are very, very heavily weighted on bonds. Very weighted on bonds. Now, that can be a good thing. I'm not saying bonds are bad, but when you have a rising interest rate environment and you have a static component on bonds, that can overly weight down your overall returns. We see that in the marketplace. Ours works very, very differently. I'll let Tom comment on some of this. In addition, another example is the significant challenges around inflation. I mean, inflation, we all see what the price of gas costs, the gallon of milk, what that costs. Inflation obviously is hitting a historical high. For us to have commodities, which that is another lack of, I would say, what we see in the marketplace, not having commodities within your index construction can cause challenges, where we've made a choice to include the commodities. So those are some high level where I sit, kind of running the life department, on what we see in the marketplace. Tom, what would you add to that? You're much more versed, and obviously you're building these indexes.
Yeah, on the bond strategy piece, you've hit it on the nail that there's a lot of ignorance out there where carriers are just launching all US or they're all global. There's no zig and zag with diversification. But on the bond strategies, The unfortunate situation the IUL market is experiencing right now is just because we have its smart beta, it's a little bit like a wolf in sheep's clothing. And what we're seeing is these index sponsors, they're not fiduciaries. And just because the life insurance, ledger page, I know not AG 49, but some sort of fact sheet or brochure is showing this index doesn't mean the carrier has done an index diligence on the product. And then what we're specifically seeing in the IUL market is the indices that the FIA market launched over the last 10 years are creeping in to the IUL chassis. And what really occurred for many of those indices in the FIA market was you do illustrate under regulatory requirements using the last 10 years. And investment bankers on Wall Street, as well as some asset managers, they intentionally data mined indexes that have very high bond allocations in a period of a bond bull market. They data mined having really strong US equity allocations in some instances. And a lot of these are very high bond allocation so that they could illustrate back in 2014, 15, 16, 17, and 18, a last 10 illustration that was phenomenal because they leveraged up bonds. And now the fact of the matter is those same indices are now going to the IUL chassis in 2022 when that is the worst trade to use. As Robert Shiller, who we work very closely with, the Nobel laureate, highlights, if you build an index off of the last 10 years, you're very susceptible to getting in bubbles. And most of the indices that we see in the marketplace do that, as opposed to what we do is when we work with our indices, be it Prism or Roger or even Mo's and the new SG index, we're trying to understand using academic principles. Roger Ibbotson, he doesn't look at the last 10 years. He's known for going back the last 100 years. And to be able to understand that history has a way to repeat itself. And that's what we make sure that we have the ability, the universe, and the strategy that it can work on a go-forward basis by analyzing not just the last 10 years, but the last 20, 30, 40, and 50 years. And that we spend a lot of time on that. And unfortunately, most of the industry is susceptible right now to smart beta indices that were built for 4 or 5 years ago based on the last 10 years of performance. That's an awful way to select a strategy.
Yeah, thank you. Thank you. So I'm going to give it, I'm just going to give you the street talk here. Static bonds could be very dangerous, right? One of the major takeaways from today's lesson. Not having access to commodities in a high inflationary environment, also dangerous. And not having access to complement the S&P with the global, also highly dangerous, right? So,
and another way to, and I would say having other ways to allocate to the S&P, maybe there's another weighting or another mechanism to be in and out, looking at the valuation of the S&P as opposed to just accepting that as our benchmark every minute.
Right. So they're major.
Yeah, Anthony.
Yeah. So
Anthony, I just want to mention one other takeaway. I think it's really important is that we want to make sure that the stability of these uncapped par rates are sustainable, right? We're not trying to beat the S&P. That is not the objective. We believe over time by just maintaining a steady, consistent, get on base return with these index constructions and remove the volatility from the conversation, at least minimize it. We know with 100% certainty that our uncapped par rates on our volatility control indexes will be much more sustainable. They won't have a shock to them where you saw back when the pandemic hit, where you saw, some carriers that don't send me any more S&P business. And that's just an unfortunate result of pricing and the cost of volatility. We were able to maintain those uncapped par rates along the way. That is a really important part of the not only just the index construction, but because of the index construction, the IUL design is much more stable. And what does that mean to the advisor, you all on the call? It means a higher probability that the conversation with your client is much more about winning than apologizing that par rates just came down and the structure of the contract changed. We want to minimize all that noise. Thank you.
Well said, James. And John, I'm just going to ask you a question that I know the answer to, but I think the audience needs to hear. You've backed up the statement that James just made, that you believe your product is more sustainable and you believe that you will best maintain the uncapped par rates. So how have you supported that contractually, and what guarantees are you providing to your clients?
Yeah, great question. I mean, well, the bottom line is it's all about the pricing, right? And Tom will probably speak to this at a more of a high level here, but going to, having the buying power, negotiating those options, that's a little getting into the weeds, but Tom best explains it. Tom, go ahead and explain that real quick on the purchase power, right? And the discounts that we get on those options.
Yeah,
It's just a great
absolutely.
story.
So the risk controlled indices that we're getting, the smart beta indices, have an ability where they are much more stable pricing. So in the case of working with, let's say, Nationwide actually has contractual hedging agreements, pricing agreements with UBS for Zebra and JP Morgan for Mosaic, where they buy the options at formulaic levels. So this isn't a trust me on Wall Street. There's a legal contractual obligation where the banks are providing those hedges. That allows the actuaries and product developers at Nationwide in conjunction with us to create a product that has that confidence, hence we can have those guarantees. In the case of the work with Securian and Prism, I work to make sure that numerous investment banks can support that. And one of the things that we're blessed to have at Annexus, Annexus, we're now in our 16th year. We've written over $50 billion of premium in the life and annuity market. And most of that right now continues to be really in the smart beta marketplace. As a result of that, that has made Annexus the biggest purchaser, thank you to clients like you, of smart beta indices in the entire Wall Street marketplace. And the purchasing power and competitiveness that we get from the banks, and we can extend that to our carrier partners, allows us to have the strong par rates with the design of knowing that we can get the contractual obligations from the banks, which then can be passed on into product structuring designs that Jon just highlighted.
Right. I mean, much like the participation rates, 100% guarantees, throwing that back into the contract. High participation rates are great, for certain situations in the economy. But when you look at, what's going on in the world today, right? I mean, when you look at those lower par rate guarantees that are in those contracts, that's something that we just don't feel is adequate to have in the contract for our clients. And for you all on the phone to be able to explain to your clients, how can that be at a 130 par rate and drop down to a 5? Granted, the carriers will never drop it down to a 5, but the fact that it can go below 100%, it causes questions in the client's minds, and that's hard for an advisor to explain.
Yeah.
So great job.
Coming out of this struggling cap environment, the feedback I get from the field is that we can't be wrong twice. We
Right.
have to get this right. You can't have a contractual guarantee of 15% participation rate. You can't be wrong twice.
Well, the other thing is
Anthony,
go ahead.
No, Tom, I was going to mention just one thing here. I mean, as Tom creates these various indexes and we convert that back to the design, we want to remove as much risk as we can. And one of those risks is a renewal rate risk. And that can really blow up a plan. Remember, we're doing these, and we understand these are 10, 15, 20, maybe 50-year transactions on a young client. And we just want to remove that probability of that risk the best we can. Tom.
Yeah, and we've been talking about the cap. Just because the cap says 5, 4, 7, that doesn't mean that's really where Wall Street actually even thinks the market will go. So, part of our design, we've been talking a lot about the engineering of our product and our robustness. But what about, and when we think about the index, and this is going back to some of the points earlier, we need to make sure that that index has the ability on a raw basis to still provide positive returns. We were saying our smart beta indices, can they do 4.5%, 5% before applying the par rates? When you look at capital market assumptions, and all the major firms publish all their Wall Street forecasts, the S&P 500 taking out dividends for the next decade is supposed to still do around a 4%. So don't think that the market's going to do double-digit returns like it's done the last decade. Wall Street doesn't see that. And for those that have said, well, we've just seen a pretty big pullback in the US equity market, yes, I'll admit that. But still, at this point, it's still, according to Robert Shiller's CAPE valuation, which is considered one of the more robust and tested valuation metrics of the equity market, it's the third highest period still, only higher than the 99 tech bubble and the Great Depression. We've given, it was even higher a few months ago, I give you that, but we're still at those elevated levels. Don't think the market's necessarily cheap based upon valuation models.
Great insight. So putting all the pieces together, if you're kind of sitting in this one size fits all, right? What do the next 5 years look like for your LERP strategies, your volatility buffer strategies, your premium finance strategies in a rising interest rate environment? What is to come? Where do you see this in the next 5 years?
Well, in terms of what, when you say, I'm not going to say I always have a crystal ball, right? But when we look at the consensus of Wall Street capital market assumptions or forecasts, you do see better opportunities going global. You know, that is something to be highlighted. You know, I realize that we're in a turmoil globally with Russia, the threats of China and Taiwan.
Mm-hmm.
So I'm not saying right now, but it reminds me of when I went to JMU. Brooks Marshall was a professor at JMU at the time, used to say, a bad company could be a good stock. And as a proud American, I think a US is the leader in our world, in our global economy and democracy and commerce. But that being said, a bad country, and I don't mean Russia, I mean a bad country is not as well situated as the United States, might be a good country stock. And that's because of valuation. So we got to keep that in mind. Then under two is, we've been in a phenomenon where value stocks have gotten really beat up. The idea of buying energy and financials and non-cyclicals, it's all been about, especially with 2020, Zoom and Netflix and Facebook. There's still those stocks that got beaten down, not just for a year or two, that was going on for a decade. So we do think smarter ways to allocate to the S&P 500 works. Commodities, not to get on a political soapbox here, but you do not see the vision of the late Boone Pickens and North American energy independence opening up here. You don't hear when oil right now is $117 a barrel. No one's saying able to drill. Right now, the demand, you don't see the demand for automobiles is astronomical, and say, well, I'm going to go electronic. Well, the price of a battery is going to be astronomical due to nickel. I think we're going to have, you got to continue being concerned, and Wall Street continues to see positive opportunities in commodities. So that is going to be the universe, the building blocks I would think of, not just the S&P 500 and bonds. And then to your point, there's still so much uncertainty. So the ability to have robust tactical strategies or smart stock selection strategies in your indices is the way we're going to have to be here. It's not a set and forget it.
All right,
yeah, Anthony, the other part of that, if I can, that I get really excited about, I think it's an awesome time to be in the life insurance business. You know, I've not to say that I've done anything other than just like you all worked hard in this industry, and you start to feel this various cycles of different types of trends. And this feels to me, the first time in my career, there's a little bit of a wind. I'm not saying it's a big wind pushing toward our backs, in that you have so much pimped up demand for different structures, whether it be a premium financing structure. I still believe, even though rising interest rates will definitely hinder some from buying premium finance, I still think that's a robust marketplace. In fact, I think the pace of a higher net worth client, that kind of client will not even won't even think twice about borrowing rates at 4 or 5%. I just don't think that's going to be the case. I think the alert strategies along the way, all because of tax legislation, the pending, but also just knowing there's nowhere else really to go to get these really tax efficient buckets. And then going back to Tom's comment about coupling all the planning ideas that although you implement every single day, we're very, very focused, whatever that planning strategy is the probability of whatever is being discussed at highly sophisticated sale, premium financing, to a LERP sale 53-year-old guy that's trying to maximize my deal the next 10 or 15 years. How can we design a products on an IUL chassis that's responsive on a going forward basis to navigate through whatever we're going to deal with? And that could be a wide variety of things. That could be contraction. That could be an equity run. That could be continued interest rate environments going up. It could be inflation. How do we make sure we build something that helps respond so the planning technique can happen?
Well,
and probability to win.
Yeah, well said. So responsiveness is a key word. So what we've learned thus far, I'm just kind of reset the discussion. What we've learned thus far, you want an index that is not in a static position, right? You don't need to sit and take it anymore. We don't have to do that. There are more options. You want a guaranteed participation rate. You need that comfort, right? You can't be wrong twice. You want the option to move into commodities in an inflationary environment, and you want that zig and zag. You want that global and the S&P, right? So now you have several very important tactical pieces of the puzzle. Now you're at the kitchen table, Tom, and the agent needs to describe, how do you move the chips around? What's it going to look like? How do I know when you're in commodities, when you're supposed to be? Like, can you forecast a recession? So give the agents on the call some dialogue that they can then share with their consumer. We've established what's important in these smart indexes, and we have the tools available through the Annexus platform at Nationwide and Securing. Now let's translate that conversation to the consumer.
Absolutely. And it's going to be a much simpler message here. And it's all true. First of all, having the ability to allocate to the S&P 500, that's a 65-year-old strategy that we've seen over and over in the worst types of situations fail. So they're just like anything else in the pharmaceutical industry or technology, there's better methods. And we've been able with you to be able to provide you that better method. So for example, working with S&P, right? Not saying, S&P is innovated over 65 years. So utilizing a smart version of the S&P in our Securing product, the leading index firm, but in a smart manner that is able to conquer the US marketplace in a better way. Going global with the prowess of our SG Global Index, so that if the smart S&P, as much as that's in the best position right now, and it's done so well with proven track record, the ability to zag the global market to the appropriate time. Indication nationwide new heights. The ability to work with one of the most famous Yale professors and his award-winning behavioral finance, his award-winning finance research that gathered so much interest that the New York Stock Exchange, the biggest brand in the United States financial marketplace, actually has owned and now calculate the work of that index, the NYSE Zebra Edge Index, and has 6 years of live performance, which has been really the lead and some of the leading type of performance. And then if global markets do better, the ability to zag with that allocation, working with JP Morgan, really one of the leading global banks in the world with their global multi-asset index. So you need to have, that's the story.
Well said. So give us some ideas on how are the chips moved around on a daily basis, weekly basis, monthly basis? Who is it? An algorithm making these decisions? How do you explain to the consumer this particular strategy, this particular manager, they're watching the store, they're going to make these decisions for you. You don't have to think about this.
Yeah, so what I would say, and again, we don't want to go if you're talking to the consumer, I'm not going to be getting into the weeds about all the mechanisms and what we want. But I'm happy to share that with you. I'm very proud about the returns, and I get, I can get really geeked out on how Prism has perfectly navigated the markets over the last 4 years. But what I would highlight is these are rules-based indices, hence the smart, engineering. They're smart designed, that they are tactical and rules-based in nature, with the Nexus with a proven track record, that ultimately they're calculated by a third-party group. So S&P and the S&P Prism Index is calculated at S&P. I build it, the buck stops here in terms of the design and our diligence on it, but I'm not calculating here in my home in New Jersey. S&P is calculating that index on a daily basis. That comes around 5:30. And that, I think, gives a lot of assurance that that brand and ownership is doing that, just like Zebra Edge. The New York Stock Exchange every evening is calculating the NYSE Zebra Edge Index. So as much as that very famous Yale professor, and his name is Roger Ibbotson, his award-winning finance research, he put that into a rules-based strategy. That rules-based strategy, though, is now housed at the New York Stock Exchange on a daily calculated business ability. And the same with our other two indices.
Tom,
Yeah,
that's
Anthony, if I could add just some color there too. What we're finding when we're having conversations with advisors that are selling the Annexus product, here's kind of a common theme about what we hear as we're taking it to the market at the kitchen table as well. Is when you start talking about the S&P, everyone obviously recognizes who the S&P is, and then from there you start talking about this concept of it constantly rebalancing, but also being multi-asset. You know, this idea of having S&P branded, track and validated by the S&P, but also having multi-asset. And what does that mean? Commodities, it means treasury. And when you start having that discussion, it's not too much different than the client's current assets that they currently either manage themselves or their broker is managing their assets. They're not 100% one thing 100% of the time. So we're finding that intuitiveness of just being multi-asset, including the S&P, and then rebalancing as needed. I mean, that's kind of vernacular around that conversation, and it's pretty intuitive. And we're finding just that baseline of conversation resonates really, really well. So that could be on the S&P Prism, which is the Securian product. It could be on, the second one would be the Zebra Edge that Tom built with Roger Ibbotson. It's the same type of concept. It's the equities of the S&P, and then on a quarterly basis, again, going back to the intuitive conversation, we're going to remove anything that's highly volatile and overpriced. And just think about that from a consumer. We don't want to buy anything that's overly volatile, and we don't want to purchase anything that's overpriced. So when you start going through the conversation on both indexes, the both smart S&Ps, when you start having an intuitive conversation, you're going to find the client resonates with that because that's how they want their assets to work anyway. So just a little color on the feedback we're getting from, you know, advisors out there, from a high net worth client, ultra high net worth, to someone like myself that's just trying to stuff in 40, 50 grand, whatever, over the next 10 years. It's pretty intuitive. And then you start, as Tom said, tracked and validated by the S&P or the New York Stock Exchange. That kind of helps, dial it in a little bit. Thanks, Anthony.
Right. And some of the things too, like when sitting there with the clients that I'm hearing from advisors, is keeping it as simple as, hey, we have investment options inside of this life contract that really help eliminate the emotional roller coaster, right? They're not designed, waiting for a happy anniversary date to end, right? And then you talk about the pandemic, financial crisis, you talk about different events that have happened. You just talk about keeping it simple. And then discussing the options with them. Once they understand, okay, well, that sounds a little more reasonable than this garb over here that's got 18 different options that you can't explain any other one to them, right? They want to hear that the emotional roller coaster, cutting through volatility. They want to hear all about that after, of course, it's explained to them, because half of them don't know what that is. So I think our story is really simple.
Really good point.
Yeah,
really good point. And what he's referring to, the two marketing pieces that we'll make sure that you have, Anthony, for a follow-up. There's two consumer brochures that tell that story. The narrative about, at a high level how it works, but also it does a nice job of demonstrating almost what time it is, not so much how the watch is made, but it talks about the consistency. That's the objective. It talks about working in different market conditions, the equity run, the pandemic, the financial crisis, whatever that may be. And it shows a nice visual to demonstrate the overall purpose of both indexes at the kitchen table to help them understand. John, good point. And we'll make sure, Anthony, you have those two pieces to make sure the follow-up for your advisors.
So I'm going to put you gentlemen on the spot a little bit. How have your smart indices performed over the last 8 months compared to your competitors?
Well, we at Annexus, across our life and annuity market, we actually have 3 of the leading indices across the entire life and annuity market, which we're really proud about. And I think it highlights our perspective. Specifically, when we talk about the market for IUL, the S&P Prism has done a phenomenal performance. It was really the first to be able to pull out before the COVID market. It understood it got right back in for inflation. It put whatever recoveries we had in 2021, and yet through that process, it pulled out the bond market. The net of that is actually over the year to date, that's up 3.24%. Over the trailing 1 year, that's up that's up 7.35% as of yesterday, and that's before the par rates. If you put in the 300, the 3-year par rate, you're getting almost the 15% returns. When right now you see the S&P 500 down 13%. Year to date, that's a 16% outperformance, and at a product level, we're actually talking, that's amazing. So when we look at other indices that are more, our Zebra index, for example, that has not done as well as that index, but when we've seen in that peer group, U.S. smart beta strategies down 6, 7, 8%. The Zebra is still holding on to a positive 1.27% one-year return. Year to date's down 2.9%, which if you're going down a multi-year structure, you're not trying. Part of our situation is we don't want to have indices going down 20, 30%. They might go down 1 or 2 or 4, 5%. But then the recovery, they're not having to dig out of the hole. So Zebra is outperforming there. And then globally, it definitely would make sense due to the global challenges right now that our global indices are underperforming those, but we're still talking down about 4%. We're not talking down double-digit type of scenarios.
Let me add just a little color to that too, if I can, just on the fundamentals that Tom just walked through. I mean, we're very pleased about how well these indexes have performed. And along the way, as we all recognize, we're going through kind of a weird time, right? Volatility. I think, Tom, you referenced something in April. It was the largest volatility in the equity market since the early 1800s. I mean, since the Great Depression, excuse me.
The worst equity start since the Great Depression, and the worst bond market since 1842.
So you start compounding all these different things within an IUL construction. We don't want to lose the fundamental of the integrity of the fundamentals of the IUL, the uncapped par rates, and the different things along the way. Where if you're an S&P design, I was just on a call yesterday with a carrier. There is significant more pressure on uncapped credit designs on the S&P for what Tom just referenced, as well as the cost of the options. So yes, the indexes are performing well as designed year to date. They've done historically phenomenally well. I'm most proud about the fact that the integrity of our IUL structure on these smart beta indexes are stable. We're not talking about dropping par rates. This is not the time where you want to drop a par rate in a situation where your indexes are doing what they're going to do. Here's the other part that's really, really important, and I'm realizing this more and more because we just came out of this large equity run. Everyone is chasing returns. Everyone is chasing returns. We historically have seen the largest bull market in the last 10. We bowed that in. We saw IUL contracts, our IUL contracts on an S&P design that hit an 87% 2-year return. Fact. Now, on a going forward basis, things are different, and we have to acknowledge the fact that there are going to be times in our index construction you may get a zero. You may get a 0 on our product. And that's just how these indexes sometimes work. What we want to stress is over time, can we meet the objective of the illustration? Can we exceed the objective of the illustration? And can we have more consistent returns year after year? And can we keep our par rate stable? And when we do that, the end game, we feel will be further ahead than all these other types of designs because of all the different volatility risks you have to manage. We're not chasing returns. We're not saying we're going to beat the S&P. We are saying that over time that we're going to put the client in a better position to meet and exceed the expectations of the conversation because how it's built.
Well said. Well said. All right, we're coming up on the closing minute or two. So one last closing question. For each of you gentlemen, you are in the IUL market. What carrier and what allocation are you selecting for your own personal policy, knowing that you're 3 of the most young, healthy, handsome gentlemen in our industry and fully expect a preferred plus rate class? Jon Elder.
Well, here's how I'll put this. Since we have Tom Haines on the phone, Tom Haines, I think that he's being a little humble over here. So he said that the buck stops with him with the S&P Prism. Number one, it's the number one smart beta performing index in the marketplace, right? So we're seeing a lot of blends. We're seeing a lot of 1 and 3 year designs. And they're also blending in a lot of the 2-year uncapped with the point to point. As James mentioned, we had an 87% return, right, on the 2-year uncapped in that S&P 500 option. Now, not to take away from Nationwide, but you're seeing a lot of zigging and zagging there as well, because we know that international is going to rebound. We know JP Morgan, the Mosaic 2, it's going to come back, right? It's taking some hits now, just like all the international plays out there. But you also have the stability of the domestic with the Zebra Edge. So you look at 50-50 with the Zebra Edge and the Mosaic, and then you look at the Prism with the S&P blend. I mean, it's just kind of, and then throw in on top of that, the new index we just added with the SG Global, right? Now we have another play in the Securian offering, okay? Much like the Prism, everything you like about the Prism, but now we're going global with that, with equities, commodities, and bonds. So it's really hard to put it, everybody's situation is different. We are young, healthy, but I mean, it can change. The beauty of our design is that we can go in and out of these allocations as needed. So there doesn't have to be one, square peg, round hole type, situation.
John, I'm going to sift through that. I think you called it the nationwide new heights with 50-50 blend Zebra Mosaic. We'll leave it at that. We'll leave it at that.
Safe play. Safe play.
Yeah. James,
on the spot.
James, what do you buying?
I am 50-50. I am 50-50. Both sides. Securian, Nationwide, 50-50.
James, you're over 50, I think.
I am over 50. You're right.
And what James, what allocations?
So I'm doing the on the Prism. I'm doing the 3-year Prism. 3-year Prism. That's that uncapped nature of 190, and then I have some in the 1 year. I've yet to allocate into the SG Global yet on my policy, but I will be repositioning more to that international side. But 50% of my dollars will be domestic, and 50% will be global. I'll split between the 1 and 3 because I like going longer duration. Going longer duration, your option costs are cheaper. You get higher par rate, 190. And then on the new heights, I'm going 1 year Zebra. I'm going 1 year Zebra, and I'm going the choice plus the buy up on the international. 1% fee minimized. I get 30%. I believe that's number 30% more on cap par to help my averages. Tom, what are you doing?
Like it.
I co-built Zebra Edge with Roger, so I loved our global indices. On Securian, I go 1, 2, 3. The 1 year with the new SG, and 2 years actually with the S&P uncapped. I actually think that's still a good value. There's a whole diversification benefit of still bringing that in against the other, and then the 3-year Prism. So 1, 2, 3. That's simple to remember. And then on new heights, I'd probably just stick to the either if you want to go with the 1 year on 50 Mo's, 50 Zebra.
Well done, gentlemen. We are very appreciative of your time and your contribution to the call. This session will be recorded. It'll be on the Life Brokerage YouTube page, likely by tomorrow. A copy will go out to the attendees who were here and the attendees who actually registered but didn't make the call. So everyone will get their hands on a copy of this. We'll accompany a couple marketing pieces that James referenced in with the recording. Reach out to your local Life Brokerage marketer for sales support, concept, discussion. These 3 gentlemen are the best and brightest in this space. Not only that, they are more than accessible when you have questions and want to better understand what this market is looking like and evolving to. So be careful with these static positions. Make sure your smart betas have access to commodities, global, S&P. Keep your eyes open to the illustration game, and let's put our clients in the best position to succeed long-term. So thank you for attending, and that'll conclude today's call.
Thank you, everyone. Thank you, Anthony.
Thank you. Thank everyone.